Good morning, everyone. Today is Tuesday, March 2nd. Somehow we've made it already to March. I'm Jo Ann Koontz. I'm here with my partner, Marina Parkin, and today we are bringing to you a discussion about pensions and retirement plans for small business owners. So if you are longing to no longer work, here's how we need to set the goals and some of the options that you can take advantage of. Some of which are going to help shield you from income tax on the profit that you're earning, and some are not, but going to stockpile the kitty for later for when you are planning your exit. So I'm very interested in this one because I'm planning to exit. I don't think I'm going to be successful at this point. At least I'm not exiting this week, but I tried and Marina wouldn't let me. So wanted to kind of turn it over to you and see, Marina, what are our choices, and give us kind of the 50,000 foot view before we dive in, please.
Awesome. Thank you, Jo Ann. Yeah, this is most definitely one of my favorite subjects to talk about. I feel like I talk about this stuff at least two to three times a day, especially when we're meeting with existing clients and new clients. And it's always the common question: what else can I do? What else can I do to reduce my taxes? What else can I do to plan for the future? And the first thing that I always say is, don't buy any more stuff that you don't need. Buy the stuff that you need for your business, but don't buy the stuff that you don't need to get a deduction. Get some sort of a pension plan. And that is definitely, it's like taking money from your left pocket, putting it in the right pocket, taking a deduction for it. And even if you go with a non-deductible plan, it's definitely a benefit on the tax-free income later. So there's definitely great opportunities here. What I really wanted to highlight here is oftentimes the CPAs get asked this question often: how much should I contribute and what plan should I choose? We can definitely advise you on the tax impact of it. And we can highlight some of the pros and cons based on the situation that we see that you are in and or your business is in. But ultimately, we definitely encourage you to talk to a financial advisor as well. The difference between the CPA and a financial advisor is the financial advisor is kind of looking at your whole big picture and is looking at this big view of your life, which includes your taxation and your business stuff and your personal stuff, but also it's your plan and all of the other sources of income that you may have, all of the other assets that you may have, things that we don't necessarily look at when we work on your tax return. In looking at this big picture view, the financial advisor can sort of help you navigate on if you want to build, taxable bucket of retirement income. Or do you want to build a tax-free bucket? Or do you want to balance? How much should you have in both? Mm-hmm. That is going to depend on what other assets you have, what other income you have. So with the financial advisor, you get some of that bigger guidance, and then we on the tax side chime in and say, okay, well, if you set up this kind of plan, this is deductible, this is taxable, and so on. So I found that the best strategies that we've implemented with our clients have always been team approach with a financial advisor, where we sit down, and it's not during tax return time. During tax return time is definitely a good time to talk about the deductions and such, but the big plan and the discussion and the pros and cons are really important to take place at tax planning time, which would be the summer or the fall, where we have some time to sit down with you and a financial advisor and say, okay, what's the big picture in this guy's life, and then what kind of plan do we want to put in place, knowing what we know about the tax situation that this person is in. So if you guys are not working with a financial advisor, please let us know. We work with some good folks, and we can definitely give you referrals, and we definitely encourage you to talk to them. We have a few of them sometimes as guest speakers talking about different things. So we're definitely liking that team approach the best. So what I wanted to do today is just kind of go over the different basic plans and the pros and cons of each, and discuss the tax deductibility versus non-deductibility of each type, and maybe some of the scenarios where I see certain plans working better than others. So let's start, I guess, with the very, very basic one, which is just your traditional IRA. Now, for the traditional IRA plan, you don't have to be a business owner. You can work somewhere else. And the traditional IRA has a limit of $6,000. And if you're over 50, you can catch up another $1,000. that contribution is deductible on your tax return. The catch with that contribution is you do need to have what's called earned income. And what is earned income? It's basically income that is going to be subject to Social Security and Medicare tax. So whether you're self-employed or whether you have a salary from somewhere else, you do need to have earned income, and your contribution cannot exceed that. So if you have a salary of $5,000, you cannot put $6,000 away into an IRA. However, that $6,000 limit is not a percentage. So that's where you can put away a flat amount to an IRA plan without really looking at the percentage of what your salary or self-employed income is, and make that a contribution. Again, it just cannot exceed what your salary limit is. What is the benefit of that? Again, you're not tied as a percentage of income. You've got a flat amount. You can make that contribution before the tax filing deadline of the tax return, which is April 15th. So this is very important to know, because if you put your tax return on extension, you cannot make this contribution with the extended deadline. So the IRA has to go before April 15th. That's very important to note. What is also important to note is if you are an employee and you work for somebody else, and there's already a plan that your employer has available, you may not be able to contribute to a traditional IRA yourself. So oftentimes people during the year say, oh yeah, my employer has a 401k plan, but I don't want to participate because I don't have any money to put away towards it. And they skip the election and they don't do anything. Or maybe they do, and they do a 1% or very, very little. Then you get to the end of tax, to the end of the year, and you're getting to the tax prep time, and we prepare the return, and all of a sudden it's like, oh, well, what can I do to offset my liability? Oh, can I put something into IRA? No, because we have marked on your W-2 that you have a retirement plan available for your employer. And because of certain income thresholds, you may not be able to participate in a traditional IRA. So traditional IRA is really most commonly used for folks that don't have any other options through an employer to participate. So definitely think about these kinds of things through the year, not just at tax time. But if you are a self-employed business or work for somebody that doesn't have a plan, that $6,000 or $7,000 catch-up is definitely a great way to deduct. What we often do with my clients is we say, okay, look, let's prepare your tax return and say, if you contribute to an IRA, if you don't contribute to an IRA, what difference does it make on your tax bill? And then if you decide that you want to contribute, you can to minimize your tax bill. If you feel like, I don't have any money right now, I'll just pay the taxes and move on, that's definitely fine as well. So having a little bit of time, so to give us some time to run the scenario, even with tax prep time, is a good idea. Also, let me plug in here is if you submit your documents to us on April 5th, we're not going to have any time to prepare your return and go back and forth with the IRA, no IRA, and all of the other scenarios. So if the earlier you bring your stuff, then definitely the more time we have to work on it and work out the different scenarios for you. So so that kind of goes to talk about the traditional IRA. Let me also here talk about the Roth IRA, which is another very common plan. And what is the biggest difference between Roth and traditional is that contribution to a Roth plan is not deductible. So contribution to traditional IRA is, Roth is not. Basic traditional Roth plan is same limits as the traditional IRA, which is $6,000 and another $1,000 catch-up if you are over 50. With Roth, it's not deductible, but the benefit is when you ultimately take distributions from that account, when you retire, those are all tax-free. The kicker with Roth and why it's so popular is that it's not just the money you put in today that's tax-free coming out when you retire, it actually grows tax-free. So all of that account that is trickling in over years, when you whenever you need the money, you turn 70, and there's no required minimum distribution there to start taking it. So at some point when you retire and you do need some of that income, you start to take it out without any tax impact. The nice thing there again is that you're going to have all this taxable income. You're going to have your Social Security. You may have some traditional IRAs or 401ks from your employers that you have to pay tax on now. So it's nice to have this tax-free bucket in the form of a Roth IRA that now trickles to you and helps you pay for the tax on some of those other taxable pieces. So again, the balance here will come from the financial advisor working with you to say, hey, why don't you split your contribution and put X amount in the traditional type of account and then Y amount in the Roth, and then you're growing these different types of retirement income. I believe for Roth IRA to grow tax-free, you have to have an account in existence for at least 5 years, which it also encourages the younger you are and you start making those Roth contributions younger, then the longer your account, first of all, your account is in existence for at least 5 years, but also you have more time for that account to grow. And that also becomes a very common strategy for kids. So if you've got kids as a business owner that you may be putting on payroll and paying them, 10, 12 grand a year up to their standard deduction so that they don't have to pay any tax on the salary, but you take out of that 12,000, you take 6, shove it into a Roth account for them and just sit there and set it and forget it and let it grow. And say the kid is 14, 15 years old, by the time that they're 59 and a half, which is when you can start taking money out without any early withdrawal penalty, you have this huge multi-million-dollar Roth IRA account. So Jo Ann, we got to start putting away money for our kids.
I promise you, no one did that for me.
Well, now we can correct that for the next generation, right?
There you go. There you go.
So we go with the kind of the traditional and the Roth, and now we start to move into something a little bit more bigger in our limit and the ability to contribute, which is my very, very favorite type of pension plan is SEP. SEP IRA is basically a self-employed pension plan, which is absolutely fantastic. And I'll tell you why it's so fantastic. I talk about that with all of my small business owners, particularly people who may be new to running their business and they kind of feel like they can now contribute to something a little bit different than just a traditional IRA, but they're not sure. They don't know if they're going to have any money left or not. So with the SEP, it's called SEP IRA, but sometimes it's referred to as SEP. But note that when you say IRA, it doesn't mean that it's SEP. So you have to use the word SEP to really get that self-employed pension plan detail going. So the idea here is that you are, as the business owner, contributing as the employer. So you need to have a salary as the employee of your business if you are, for example, an S corporation. If you're self-employed and you're just reporting everything on Schedule C, or you're a partner in a partnership, you don't need to have a salary, but the business, the key here is that the business becomes the contributor to the account and they contribute to the benefit of you, the employee in the business. The SEP, however, is just the one-sided contribution. So it's just the business side of the contribution. And it is set to 25% of your compensation. So whatever salary you set to pay yourself, and we have a whole new class on reasonable compensation coming up in a little while, but whatever salary you decide is your reasonable compensation from the business, 25% of that can go into a SEP plan. If you're self-employed, the formula works a little bit different, but essentially it gives you the ability to contribute roughly about 22% of your net self-employed income. That's your max. So the max starts with a percentage and it maxes out at $57,000 a year. So depending on what your salary is set to be, you can contribute up to $57,000 to this SEP. The beauty here is that you've got up until the filing deadline of the tax return, including extensions. So that here is the key. You don't have till just April 15th. you can go, if you're an S corporation and you're putting that away for you as the employee, you've got up until September 15th, which is the business extended deadline. If you are a sole proprietor and you're just reporting on Schedule C, you actually have till October 15th of the, which is the extended filing deadline for the individuals, to contribute to the plan, which is absolutely amazing. So you've got almost a whole year to be able to contribute and take a deduction for it for the year before. The
Now,
other nice thing, yeah,
you
go
make
ahead.
this look easy. Is there any rhyme or reason as to what has to be deadline with the original return versus extension versus year end? Like, how do people know that, or they just need to call and ask you?
They need to call and ask.
Okay.
They do.
Because you
And
just rattle it off like it's,
oh,
you
yeah.
know, like it's
Yeah.
normal.
Exactly. And I tell you, the other thing too is last year was also a little funky in that the deadlines were shifting, and not just the deadlines for tax filing contribution to some of these traditional accounts, but also the deadlines to open the plans. And I'll get into that in a little bit, but with back to SEP, you actually have up until the filing deadline of the tax return to open an account. So some of these plans, as we talk about them, the deadline to contribute, you may have up until the filing deadline of the return, but the plan has to have set up ahead of time. In the traditional IRA or Roth IRA or SEP, you actually have up until the filing deadline to set up the plan. So remember, with the traditional IRA, you can set up the plan and contribute, but you gotta do it by April 15th. So even if you end up going on extension, you still should make your contribution by April 15th. With the SEP IRA, different. You've got up until the filing deadline, including extensions, to actually physically make the contribution and open the plan. So oftentimes, as we're working on these tax returns that do get extended, we're working on them in the summer and we say, oh my God, you would really benefit from putting away money to your SEP plan. And then people rush off to meet the financial advisor, who rushes off to open the plan, who rushes off to make a contribution by September 15th. I don't recommend putting anything like that till last minute, but because wherever you go, they do need time to get the paperwork going. And especially last year, we saw in COVID times, everything took longer. To submit any of that paperwork with the bank to process the setting up of the retirement plan, it does take a little time. And oftentimes your financial advisor will push and they will go to bat for you, just like we do on the tax return side, and we'll push it till the last minute. But sometimes it may just be out of their hands if they're working with a company who's going to administer this plan, and they may not be able to process the paperwork in time. So even though you may have up until the filing deadline, if this is something you think you're going to do, I definitely recommend at least opening the plan, putting the plan in place. The nice thing with a SEP is that that plan is very cheap to administer. So once you set it up, your annual fees to keep that plan open are really low, which makes it a really affordable plan to set up and keep going, even if you don't contribute every year. And so that's, again, part of why this plan is one of my favorites, because the years when you're down, or you may have other demands on your cash flow, your kids are going off to college, or you need to reinvest money in the business, or there's a building opportunity like storage units that comes up and you have to buy, you all of a sudden are short on cash, you cannot find your plan. That's okay, because to keep it open, it doesn't really take much in terms of the fees. So the plan just sits there and waits. And oftentimes I have clients coming in and we kind of revive this conversation, and it turns out they've had a plan open for years, and now I am, pushing them to actually start funding it. So that's definitely a great thing about SEP IRA. The reason why as well you need to have the earned income, as I mentioned, that the limit is 25% of your salary or self-employed income, is because IRS is really trying to put you on the same footing as if you went to work somewhere else, or people that do have jobs. So when you make income that is subject to Social Security and Medicare tax, they're giving you an opportunity to contribute to some of this deductible plan. Same thing for SEP. So you can't just generate business income, shelter it from payroll tax, by creating an S Corp and then still take advantage of entire, gross revenue times the 25% deduction. So you got to generate that salary. And this often becomes a discussion between us and financial advisor when we create this S Corp structure to protect the owner from self-employment tax. We talk about how much of the reasonable compensation we want to set, because that will drive your payroll tax, but it'll also drive your ability to contribute to the retirement plan. So the balancing here is the key, and that's where we really do need the financial advisor's help to figure out, okay, how much do we want to contribute and how much do we want to save? But when it's like magic, when it all comes together, it's absolutely amazing. And people are amazed at what they can actually do once they put proper business structure, salary structure, and the pension plan in place without really doing anything different in their business. That's the key. It's not, I'm not buying you 5 more trucks that you can take, depreciation deduction on. I'm just putting you in the right structure, giving you your salary, and then putting you in the retirement plan. So it is absolutely amazing. So that's my kind of an overview of the SEP plan. Next, I want to chat about a simple IRA real quick. Jo Ann, any questions so far, or sort of any comments from you on kind of SEP? I know it's a word that we hear often.
It is, and it's something that I try to draw the distinction whenever I'm out and about speaking, because of course we're typically talking to people about how to minimize their taxes. But there may be occasions where you don't need all the income, so you are not minimizing tax, you're trying to maximize your SEP. So you have to be careful when you're engaging in conversation with folks, because it's our default in programming to talk about minimized taxes. But if you aren't concerned about that and you're really concerned about maximizing that retirement income, we try to hit that, to say people have alternate goals. But if you're talking to somebody else, you just want to make sure that you are clear that they're competing interests. You might be taking a higher payroll through the LLC just to max out your SEP contribution. Now we do have a question. Michael says, I'm a realtor that has a PLLC set up. He must have been to a different webinar. So we've guilty suspects here. To set up with S Corp tax filing status. So that's great. He says, my question concerns SEPs. If I were to open one of those up, does the account need to be in the name of the PLLC, or is it my own name? Plus, do any of the contributions to the SEP need to come from the business account?
Yes and yes. So once you have a business, then correct, the business, the employer becomes really the owner of the account, and you're making the contribution kind of for the benefit of you, the employee. So the account is going to be in the business name. Well, and when you talk to the plan administrator who's going to set up, I guess maybe our verbiage is a little different, but essentially the account is for the benefit of you, the employee, the individual, but the business is making the contribution. And so the business is going to take a deduction for contribution, and the contribution is going to come out of business bank account. And definitely the account is the owner is your PLLC. Okay.
Thank you.
Let's talk a little bit about simple IRAs. This is my least favorite plan because it's funny. I remember a couple of years ago, I was attending a seminar where they were discussing it, and the instructor said, this is exactly not simple. So I don't know why they put word simple on the plan that is the least simple out of all of the plans. So a simple IRA is kind of a transition between your SEP IRA and kind of like a traditional 401k plan. It's a hybrid, which makes it a little bit complicated. What's the kicker with simple IRA? Now you're getting into the land where you as the employee and you're the employer are both making contributions. So the limit is for you as the employee is 13.5, and I have to check the limits because the limit is like alphabet soup all scrambled every year. So it's 13,500. If you're older, you can catch up another 3,000. So it's 16,500 if you're over 50. That is your set dollar limit as the employee. You can contribute less than that, but that's the max you can contribute. Now, you as the employer put away kind of what they call match. It's not the match of what the employee puts in, it is a percentage of employee's income. You can choose for it to be either 1%, 2%, or 3%. So there's very little choices on what you can do. And why I like this plan the least is once you sign up for this plan, you have to make those matching contributions as the employer. So you cannot have a year where you say, you know what, I'm not going to do it. So even if you, the employee, decide not to participate and not to put in that $13,500 or under it, you, the employer, have to put in 1 or 2 or 3% a year. So it gets a little funky. And the other thing too, it gets very specific if you've got other employees, because you have to make sure that match works for everybody else and that you're not kind of discriminating against yourself or any other higher paid employees. So it's got a little bit of that 401k hybrid to it that really doesn't go with that much of a high dollar amount deduction. So there's definitely rhyme or reason to a simple IRA. I do see it quite a bit, but not as much as definitely the SEPs or the solo 401ks that we're going to talk about next. With a simple IRA, you have to have the plan set up by October of the year of the contribution. So the plan has to be set up in October. So if you're contributing, let's say for 21, by October, the plan for 21 has to be in place. And that employee's contribution, the $13,500 that I was talking about, has to go by December 31st. So it has to come out of your sort of paycheck before the end of the year. The employer match can go after, but the employee contribution has to go before the end of the year. So this is the kind of plan. Now you're into the different land where you really got to do some tax planning and financial planning ahead of time. You can get into tax return time and say, oh my God, what's the max I can put to my simple? That you're gone for the 2020. Now we're talking about the year and that we're in physical calendar year we're in right now, but we cannot go back and do any after the fact contributions like we did with the traditional IRA and SEP IRA. So I'm not a big fan of simple, but don't let that deter you, because there's definitely time and place for those. They're fairly cheap to administer, so I know that that's definitely a good sign, and they are a good, like I said, a good intro before you move into kind of that solo 401k from a SEP where you've got the employee and the employer part to it.
Now you brought up a good point about having to do the planning before the end of the year. What does that mean? Does that mean like just call on December 22nd for an appointment?
Preferably we're talking about this sometime in May, June, July, August, September.
Okay.
That would be the perfect
not the week
time.
before Christmas. And
not the week
trying to get the
Christmas.
financial advisor to open the account and you to give them a number.
This is always a nightmare. That those Christmas tax planning strategies where people have to open an account, and I feel bad for these financial advisors that are put in a situation where, you know, we get the documents from a client, we try and do the tax planning, and of course I often talk about, let's set up a retirement plan, let's get up to you know, get in gear to do this, and here comes the phone call from my friend at Merrill Lynch with pulling his hair out of and saying, what did you say? What did you do?
You woke the beast.
Now we got to hustle and open this account, and like I said, a lot of times they may not be able to get that done. So definitely talking about the opportunity to do it. You don't have to pull the plug, but start talking about getting the account open way ahead of time, I would say, in the fall. And that's why, you know, simple does give you the, and let's see, October 1st is the deadline that they've given to actually establish the plan. And that is really, out of all of the plans here, is the earliest deadline.
You said October 1st?
Yep, October
Wow.
1st. So the plan has to be in place. Again, you can, the nice thing is once you have the plan, you can make that final contribution. Even if we're talking on December 26th, make a contribution by December 31st, that's fine. You got to have a place to park it though. So,
perfect.
So let's talk a little bit about the solo 401k, which is after SEP is my next favorite plan. So solo 401k.
You're so easy to please.
I really am. It really doesn't take much. I do get excited about these things. And I get excited about them because I see them working. It is incredible. What's incredible to me, Jo Ann, is how many times I have to tell a client, do this, do this, do this. Like we work with them 2 years, 3 years, 4 years, and then they finally do. And then they finally make a contribution. And then I show them the actual tax savings that they've realized from contributing to the plan. And it blows their mind. And then they said, we could have been enjoying this for the past 4 years, but better later than never. But
Right.
please just listen to me. Listen to me. I think this would definitely benefit you. But people get a little nervous. You know, it's a plan. What does that mean? Where's my money sitting? People are kind of distrustful of if it's not under my mattress, is it going to go away? And, you know, these plans are regulated. These plans are, you know, you're paying the plan administrator to make sure it's compliant with the code. There's definite regulations to make sure that the money, you don't take the money and run away. And so it's, if you trust that there's going to be Social Security for you when you retire, there's definitely going to be something sitting in your SEP IRA account when you
You
retire.
don't trust Social Security, you really need a SEP IRA?
I get all sorts of, I mean, I think I've heard it all. I've heard all sorts of kind of like devil's advocate comments from clients. And I said, you know, at the end of the day, you know, this, we can set up the plan as a financial strategy and a tax strategy, but if you really don't believe in it, you really shouldn't do it. Pay the tax and move on. It's not my job to kind of convince you that this is a great idea. If you have a different, you know, we will work with your comfort level, and financial advisors tell you the same thing. In fact, when they, you know, question you and say, what do you want to kind of invest in and what's comfort zone, they will work within your parameters that you set and say, I don't want to invest in this, or I don't feel comfortable with that. No one's going to force you to do anything. But I think it's our job to educate you and to say what we see from practice standpoint. And we see people in all sorts of situations and in all stages of their life. I mean, I have people that I see taking now money out of their Roth accounts and taking money out of their IRAs and pensions and enjoying the benefit of the taxable versus tax-free income. I have people at the very beginning stages of growing their business where they don't have any cash whatsoever. I have people in the middle that are growing their business and now there's cash flowing and they want to know what to do with it. So it's just kind of our job is to, again, educate you and enlighten you and give you all these different options. And then hopefully you will listen to, if you listen to 25% of what I say, I think we'll be in good shape. So maybe not 100, but 25 would be good. Even if it takes me 4 years, I'll get you there. So 25% per year. We'll have a plan in 4 years from now.
This is my plan.
That's my plan. That's my plan. Mm-hmm.
Oh my goodness.
So the solo 401ks, why I love those plans is, again, this is a plan where you need to have payroll. So you need to be an employee of your business. And the solo means it's either you or you and your spouse. So if you have any other employees, you're going into just a traditional safe harbor 401k plan, which is very similar. It's got some additional cost to it, and I'll talk about that in a few minutes. But when you're dealing with solo, so it's either the owner or the owner and the spouse. With a solo 401k, super cheap to set up and very cheap to administer because you don't have a lot of those traditional 401k rules that you have to comply with. So it is more expensive than SEP, but still very, very manageable to set up and administer every year. The key here is that you, again, have the employee contribution and the employer contribution. Your employee contribution is much higher than simple IRA. Your employee contribution is now $19,500. And it's another $6,000 or $6,500 if you want to catch up. So you can put away $25,000 or $26,000 this year if you're over 50 to your solo 401k as the employee. And you and your spouse can do that as well. Then you turn around and you as the employer can also put in a contribution. The employer's contribution is maxed at 25% of salary. So without having any other employees and worrying about matching their salary, if you set your contribution on the employer side as the max 25% of salary, between the employee contribution of that 19.5 and 25% of salary, you can really stash away a really good chunk towards the retirement and take a deduction for it. And this is where I encourage to put a spouse on payroll as well. If your spouse does not have another job, or maybe has another job but is not, maybe their income is limited there, put your spouse on payroll. And if you're looking for a way to make a deductible contribution, then both of you can contribute $19,500 each, plus yours, the employer, puts the 25% of salary in. The total combined contribution between the employee 19,000 and the employer 25% is limited to 57,000 per person. So between you and your spouse, you can put away what, 115 grand to this plan and take a deduction, which is absolutely amazing. This is also the situation where, again, we work with you to set the salary limit to say, okay, if you've got a business, we're going to set your salary to be at this level. So you've got the 19,500 that you can put away. So you've got to have salary of at least 19,500 because you cannot contribute as the employee more than your salary. So whatever salary is, then 25% of that gross amount equals the employer contribution. So we kind of play around with, again, let's set the salary to be reasonable and to sort of minimize the payroll tax, yet give us enough basis where you're feeling comfortable with the amount of the contribution that you want to make. And typically, if you are over 50, if you set your salary to be at about 100,000, you can hit that 50,000 limit pretty quick. So let's say we have a client, and we've been doing this several years with him. Once he hit 50, we set his salary at 100,000. So he's putting 26 as the employee, and then 25% of 100,000 is 25. So he's basically contributing 53,000, almost max to that 57 every year, and his spouse is on payroll as well. So they're both able to do the same thing. So it has worked really, really well. The nice thing there too is if it's just two of you that are employees, we can change your salary levels. It's not like you set your salary on January 1st and it is what it is. When we do our planning, again, I'm back to the importance of planning in the middle of the year. When we talk in, let's say, August or September, and we say, look, you have moseyed along for the year, your salary was at 30 grand. Now all of a sudden your income has quadrupled, you're doing really well, you're selling all this real estate. Let's get your salary up higher. So you go to your payroll provider and you change your salary up to whatever the income is, whatever we decide that limit is, and then we really hit that 401k contribution. The deadline to set up the 401k plan, the solo 401k, is typically before the end of the year. But just like Jo Ann said, please don't call anybody on December 26th. We had a little bit of a nightmare happen with a client last year where they thought they can set up the plan that last minute, and first they could, and then turned out they couldn't. Just administratively was really, really difficult for the plan administrator to make it happen, and they ended up not, and they really were counting on making that contribution. So it was a little bit disappointing, but I really, really think that this is the kind of stuff that we do need to talk about through the year. So you set up a plan, you can fund it. The employee contribution definitely has to go before the end of the year. The nice thing with these solo 401k plans, again, is even though that 19,500 has to go before the end of the year into the plan, the employer contribution can go after. So you have up until March 15th to contribute that max as the employer contribution and take a deduction on the business tax return. So you have some time. You don't have to put on that whole 57,000 in one shot. You have some time to make it happen. Same thing with the flexibility, like with the SEP. If you, on the employer side, don't want to put 25% every year, then you don't. The plan is small enough where it's easy enough to change. It may be easier to change the employee part. So if you set the employer part to be 25% of salary, that can go every year, but the employee portion, if 1 year again you don't have the cash, then don't max that 19,500. Maybe put away nothing or put away a little bit. So that's where I think the flexibility of the solo 401k it gives you the ability to change that. If you have other employees, then you are out of the solo 401k. You're into kind of the traditional 401k. But if you talk to any financial advisor, plan administrator, if you're a small plan, there's still a lot of flexibility on setting up the safe harbor. And safe harbor just means that the plan is designed in such a way that it allows you to comply with the 401k and be able to meet the requirement where you are still not discriminating against putting away more contribution for you, the owner. You're still matching properly the other employees. Whatever percentage of salary that you set to contribute, you have to do for other employees as well that you've got on payroll. So in the designing of the plan, you want to balance that too between the cash flow and also the ability to provide the benefit to these people. Because if they decide even that they don't want to contribute themselves as the employees, again, they may not have the cash, but if you provide that benefit that you're contributing, let's say 10% of their salary or 5% of their salary as to their retirement account, that's viewed as kind of a fringe benefit to them. You get to take a deduction for funding a pension account for your employees, and it's an extra thing that becomes part of their overall compensation package. So oftentimes people say, oh, I have employees, am I going to do this plan? And I turn around and I say, yeah, but that could be a thing that makes your business attractive for these people to come in. Maybe they don't have anything stashed away for their retirement plan, but you can make in the contribution to their account for them, gives them some comfort that there's some retirement plan growing. The nice thing with that too is you can actually set vesting schedules. So whatever you put into their account, they can immediately take at the end of the year and leave. So it kind of forces them to stay if they want to be able to get 100% of the employer contribution. And typically, we're talking about these plans when you've got some good employees that you want to get on the plan and want to benefit from these contributions. So setting the vesting schedule is great because, these folks are going to be around for 3 to 5 years at least. And, they're going to be around to see their contributions grow. And it's just kind of a good strategy, business and tax all around. I find that works really, really well. Any questions there so far, Jo Ann?
No, we're all good.
Okay. One sort of range that I wanted to throw in this 401k equation is in the last, well, let me back up for a minute. So in the last several years, as much as everybody complains about paying tax, really our tax rates have been really low. Especially with the Trump administration, the tax bill that he put forth in 2018, where the tax brackets have lowered and the tax rates at these brackets have lowered. The overall effective tax that people have been paying has been much lower compared at the same level of income, putting everybody on payroll and maxing their 401k. That's all great. However, when you're in the lower tax year, that contribution and the deduction is not worth as much to you as if you make it in the higher tax year. So last year, when we were seeing the shift of our administration and everybody was afraid that the tax rates are going to quadruple, and we of course don't know when anything is going to happen. The anticipation is that the rates are going to go up. We are not sure when, but people sat and said, okay, wait a minute, maybe this is the year that I sort of put a break on maxing my deductible contribution and instead fund the types of contributions that are non-deductible now at lower tax rates, but they're going to be tax-free in the years when I'm going to start taking money out when the tax rates are going to be high. Because if you are not benefiting it at 20%, but you've got this tax-free money when the overall rates are 25%, you've definitely won. Of course, the crystal ball is nobody has it, and we don't know what the rates are going to be when we retire. I can tell you one thing though, people say, oh, when I retire, my income is going to be lower. That is not true. That is absolutely false. If you're a business owner and you're building a business and you're doing really well, you are still going to generate a substantial amount of income in your retirement years, whether you continue to run your business or maybe you sell your business and you continue to receive some of that deferred payment on the business. People buy real estate and then they start divesting of it or receiving the rental income or residual income from it. Whatever your setup is, people are no longer on just Social Security when they retire. And we see this all the time. I see my retired executives that are moving here looking forward to retirement, and I tell them, oh, I'll see you next year. Because the next year they get bored, they come in, they start a business, they sit on the board, they get fees, and again, their income is back up to being substantially high. So you still have to plan for your retirement years to have taxable income, and you have to think about the tax rates that are going to be in place. So with all that said, there was a big shift in mindset as far as these retirement plans went last year. We were talking to people about, you know, maybe instead of doing the traditional IRA, let's do a Roth. So you contribute to it, don't take a deduction, but it's going to be tax-free when you take the money out. All that to say that several years ago, these 401k plans have designed a Roth component to the employee contribution. So that employee contribution that we're talking about, which is the $19,500 max for the employee, you now can design your plan to have a choice. That contribution can either be deductible or it can be a Roth. So if you make that contribution a Roth, it is not deductible, but again, you're growing that huge amount tax-free. What is the biggest benefit of doing the Roth inside your 401k? You don't have the traditional Roth limit of $6,000. So you can set your whole entire employee contribution of $19,500 to go to Roth, which is a lot more than you would have otherwise been able to contribute to just the traditional outside Roth account of $6,000. Mm-hmm. And then now you've got that $19,000 that's growing tax-free, while your employer contribution at 25% of your salary has to be deductible if you make it. You cannot make that Roth. So what I saw a lot of times last year when we did the planning was the balance. So we ended up having some clients do non-deductible Roth contribution, that was their employee, and then deductible contribution, that was their employer. So in a sense, they balanced, they got some deduction and some benefit, and then they also created this bucket of tax-free income for when they retire. And the balance between the two, that's up to your financial advisor for sure. Because I am, you know, I can advise you on deductibility, but how much to balance, should it be more or less into Roth versus traditional? We leave that to your financial advisor, but knowing that it's available is absolutely priceless. So I definitely encourage, if you are going into the solo 401k plan thought process, to build the Roth component in there so that if you do at the end of the year decide that you want to contribute and we're still in low tax rates and your effective tax rate is very reasonable, shove the money into the Roth account and let it sit there and grow in there tax-free. So that is definitely kind of a good high-level overview. Again, every single one of these things is going to be specific to your particular situation and will meet your needs. But even if I have to tell you about these plans time and time and time again, this is also the reason why we're doing this webinar, because it will get recorded, it will get posted on our website. You can just hit replay every year. I will just, I'll be sitting here with my with my coffee pointing to my webinar link. But the idea is that every year as you shift in your business and as you make more money and as your needs change, we talk about, now you're on to the next level. Now, what else can we do with the money that you have coming in? Now let's talk about these retirement plans and what the needs are. And there's different other plans that I didn't go into detail here. There's a cash balance plan that allows you to put away up to $230,000 into a retirement plan and take a deduction. And that can be a specific beast, but I've seen that work successfully in a very particular situation. So again, I had a client who, it took me about 3 years to convince her to go to this cash balance plan. And once she did, and she's putting away $200,000 every year and taking deduction for it. And every year when I see her tax time, she says, "Why didn't I do this sooner?" So it's,
you're like, I don't know, I told you.
it's definitely, I always tell her that she's my success story when it comes to these cash balance plan advice. So that is, I think, hopefully some good information for you guys. Any other thoughts, Jo Ann, kind of from, boots on the ground that you see?
So the big thing that I would say is, it's easy when you start to hear cash balance plan and $230,000 contributions. You don't need to be waiting for huge contributions. If you are only planning to put $5,000 away, you're not going to do cash balance plan, but you can still start these. And a lot of these you can roll into the next plan so that you don't have 10 different accounts in 10 different places. It's the habit of getting into doing it that is important that you cultivate, even if the business is young in its maturity, and you may not be talking about how do I hide all this money from tax, but really it's still a good foundation. We talk about when you do your budgeting for these things as well. So if you don't put you in the line item, you will spend the money on something else, and 20 years from now, 10 years from now, it's a little bit disappointing. That being said, it also needs to be juxtaposed to cash flow and health of the company. So we have to have the emergency fund established first before we venture into these things. But don't feel like you need to be like, I have no idea what to do with this giant pile of money before you can start to explore these options, because they're much more manageable and affordable and doable than what people might perceive. Lots of times when folks are on that cusp of even, I don't know if I need an S corporation, I don't know if I can do all that bookkeeping, and we explain to them, it's really not any different. You're still tracking your expenses. We're just putting it on a different form. This is kind of the same thing. It sounds overwhelming when you listen to a whole hour of 10 choices. But if you break it down into the bite size and say, well, if I'm small, where do I start? And you go back to the beginning of this webinar, you can see that this does add up quickly. And particularly when she talks about the compounding and things like that, 5 years from now, you've got a little nest egg. Now, don't be tempted because you don't want to take it out early, because you don't want to undo all the progress with early withdrawal penalties. But it is something that should be at least a piece of your overall financial planning puzzle, even if it's a small piece.
Absolutely. And I think the behavior is key. Even if you set away, even if it's $100, and oftentimes I really love it when, we do tax planning meeting with my clients or with new clients, and they say, I think I've got a plan. I've got $250 every month going to it. And I said, this is fantastic. You are already 5 steps ahead, and you've got the plan, and you're already on drip at a couple $100 every month. So now if we want to kick it up a notch, at least it's not that foreign to you. It's not so overwhelming. Oh my God, have to go set up an account or meet a financial advisor. Yeah. So getting, and then we may kick up that monthly contribution for you. But I think that getting in the behavior and the understanding of how important it is definitely step one. It's step one to awareness.
Yeah, and then it's not so uncomfortable. And then when you take the next leap, it's not like I went from doing nothing to $230,000 cash balance plan.
Yeah.
So that's it. Now, if you are trying to get to where you have all this business and you need the cash balance plan, next week you might want to tune in, because we will have Whitney Harper. She is a business lawyer from a law firm called Advos, and we've worked with them on quite a few transactions. They handle, this next week, she's going to be handling the intellectual property considerations for businesses. So whether you're buying a business or setting one up, or maybe you're in the process of developing some intellectual property right now, she's going to talk about how we can best handle that protect it and keep it out of harm's way. So thanks so much for joining us, and we'll see you next Tuesday.
Thank you.
Bye.